All right, let's just get straight to it. If you're a US tax resident, so a green card holder or a citizen, and you're running an SIP in an Indian mutual fund, you could have a huge tax problem on your hands that you don't even know about. And no, that title is not clickbait. From the IRS's point of view, your investment is almost certainly illegal. And what they do about it is, well, it's pretty brutal.
And that's really the heart of the matter. This isn't your normal pay some capital gains tax situation. The IRS has a whole separate rulebook for these investments. And honestly, it's designed to hurt. They created these rules specifically to discourage US taxpayers from holding them. And saying, oh, I didn't know, won't get you anywhere. So what's the big deal, right? You're just trying to invest, grow your money in the Indian market. Why on earth does the IRS care so much? Well, it all boils down to one very intimidating sounding acronym. But don't worry, we're about to make it super simple. The problem is something called a PFIC. That stands for Passive Foreign Investment Company. It's the scary label the IRS slaps on your Indian mutual fund. And trust me, as soon as your investment gets that PFIC label, you're playing a whole different ballgame with a much, much tougher set of tax rules. So what exactly is it? It's really simple. A PFIC is just any foreign company, and yep, your Indian mutual fund is considered a foreign corporation that either makes most of its money from passive things like dividends and interest, or most of its assets are things that produce passive income, like stocks and bonds. And here's how they catch you. It's one of two tests. The income test is 75% of the income passive, or the asset test, are 50% of the assets passive. Now think about a mutual fund for a second. What is its entire job? It's to hold stocks and bonds that create passive income. So by their very nature, pretty much every Indian mutual fund automatically fails these tests and walks right into the PFIC trap. And listen, this isn't some niche problem affecting a few obscure funds. We're talking about the whole shebang. Your equity funds, debt funds, hybrid funds, all of them. Those popular Indian ETFs that track the Nifty 50 or the Sensex, they're PFICs. Indian REITs, you guessed it, PFICs. Even a lot of those unit-linked insurance plans, or ULIPs, get treated as PFICs. The net is just incredibly wide. Okay, now for the part that I call the punitive tax bomb. Because knowing your fund is a PFIC is one thing, seeing what the IRS actually does to you because of it, well, that's where the real urgency kicks in. This is where things get really, really ugly. So if you do what most people do, which is nothing because they don't know about this, you fall into the default tax trap. It's called Section 1291, or the Excess Distribution Regime. And let me tell you, every single word in that name is designed to be bad for your wallet. So when you finally sell and take your profits, how does the IRS tax you? It is a nightmare. Step one, they take your entire gain and they don't tax it as a lump sum. Oh no. They pretend you earned it evenly, every single day over all the years you held the fund. Step two, for all the money they pretend you earned in past years, they tax it at the highest possible tax rate for that year. We're talking 37%. It doesn't matter what you actually earned. And then, the final insult, step three, they add a daily compounding interest penalty on top, as if you were late on your taxes for all those years. So what's the result of this insane calculation? It is absolutely shocking. The total tax bill, with all the interest and penalties, regularly eats up between 50 to 70% of your entire profit. I want you to really think about that. You build up a corpus of, say, 45 lakhs, and the IRS can swoop in and take more than half of every rupee you earned. That's the tax bomb. And just when you thought it couldn't get any worse, there's the compliance side. You're supposed to file a special form, Form 8621, for each PFIC every single year. And if you miss just one of those forms, the normal 3-year time limit for an audit, it disappears. Your entire tax return for that year can be audited by the IRS forever. We're talking 10, 20 years down the line. It's a permanent risk. Okay, deep breath. That was a lot of bad news. But here's the good news. This is a completely solvable problem. You absolutely do not have to fall into this trap. There are simple, totally legal, and smart ways to invest in the Indian growth story from the US without ever having to worry about PFICs. There are really 3 main safe harbors. Number 1, you can just buy individual Indian stocks directly. Shares of a company like Reliance or Infosys are not PFICs. Number 2, you can invest through ETFs that are based in the United States, like INDA or EPI. Because the fund itself is American, it's not a foreign investment, so no PFIC rules. And number 3, for your fixed income needs, NRE or Gift City fixed deposits are totally fine. They aren't PFICs either.
And just look at the difference. It's night and day. With direct stocks and US ETFs, you pay the normal, much lower US capital gains tax. NREFDs are taxed as regular income, which is fine, but look at that bottom row. The PFIC risk? Zero. Gone. You get to participate in the Indian market with simple, clean, predictable US taxes. It's that easy.
So, if you're watching this and having that sinking feeling of, uh-oh, that's me, it is absolutely time for an action plan. But don't panic. The key is to be methodical and take clear steps to protect your wealth starting today. Here's a super simple 3-step plan to get this sorted out. First, inventory. Just make a spreadsheet. List out every single Indian mutual fund, ETF, or ULIP that you own. Step 2 is evaluate. This is where you probably want to talk to a pro to figure out just how big your potential tax problem is. And then step 3, transition. For most people, the right move is to create a plan to sell these toxic PFIC investments and move that money into one of the safe alternatives we just talked about. So it all comes down to this one final question you have to ask yourself. After hearing all of this, take a hard look at your portfolio and be honest. Is it actually growing your wealth, or is it silently, day after day, just growing a giant future tax bill for the IRS? Look, if you're feeling a bit overwhelmed by all this and you're not sure where you stand, I want to help. Just send me a direct message with the word PFIC, and my team and I can do a free compliance check to help you get some clarity. The most important thing is to take action, because this is one of those problems that only gets worse the longer you wait.